Today is July 20th, 2026, and this morning two things happened that directly connect to everything this channel has documented over 43 episodes. First, two US service members were killed, one is missing, and Iran has called off its interim peace deal. The fragile ceasefire that had been holding since earlier in the year is now officially over. Second, this week brings the most consequential earnings reports of Q2 2026. Alphabet and Tesla earnings will give some idea of where the semis go next. These two events, geopolitical collapse and AI earnings reality check, are the culmination of every single trend this channel has been tracking. In video 37, we documented gold hitting its all-time high of $5,589 and identified the Iran conflict as a key driver of the inflation that froze the Fed. In video 40, we covered how the Fed cancelled rate cuts partly because Iranian tensions drove oil prices and pushed CPI to 4.2%. In video 41, we celebrated inflation dropping to 3.5%, partly because Trump temporarily abandoned the Strait of Hormuz transit fee. In video 43, we covered the semiconductor sell-off driven partly by US-Iran escalation. Today, the fragile diplomatic framework that was supposed to resolve all of that has collapsed. Iran has called off the interim peace deal. Two US service members are dead. The geopolitical risk premium that markets had partially priced out is back, and probably larger than before. Meanwhile, this week's earnings from Alphabet and Tesla will determine whether the AI rotation that's been dominating markets and destroying semiconductor stocks has a fundamental earnings basis or whether it's purely a momentum story. Today I'm going to tell you the full story of what the Iran peace deal collapse means for your portfolio, how it connects to every financial crisis we've documented this year, and why this specific moment calls for the most important framework in all of modern finance. Nassim Taleb's Black Swan Theory, the book that explains why the events that matter most are always the ones that were hardest to predict. Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. Part 1. What just happened and why it matters. Let me be precise about the sequence of events because the timeline is critical. In video 41 on July 14th, we covered how inflation dropped from 4.2% in May to 3.5% in June, partly because Trump abandoned his demand for ships to pay a 20% protection fee to transit the Strait of Hormuz, replacing it with trade and investment deals from Gulf states. That diplomatic pivot temporarily reduced oil market stress. WTI crude pulled back from its highs. CPI decelerated. Markets rallied on the inflation data. The Fed's rate hike fears temporarily eased. Then, over the following week, the situation deteriorated. An attack near the waterway, which typically handles around 20% of the world's oil traffic, reaffirmed the fragility of the US and Iran's interim peace agreement. Renewed Middle East escalation weighed on investor sentiment, as chip stocks led a global sell-off and US-Iran tensions escalated, driving oil prices 4% higher. And today, July 20th, the interim peace deal is officially over. Two US service members are dead, one is missing. Iran has formally withdrawn from the agreement. The geopolitical risk premium that temporarily eased after Trump's Hormuz fee abandonment is back, and it's larger than before, because failed peace processes typically reset to conditions worse than those that preceded the initial ceasefire attempt. What this means specifically: the Strait of Hormuz handles approximately 20% of the world's oil traffic. Any disruption to that shipping lane immediately affects global oil supply, and oil is the single most direct input into US inflation. The June CPI drop to 3.5% that we celebrated in video 41 was partly an energy price effect. With Iran now calling off the peace deal, the energy price pressure that drove May's 4.2% CPI is likely to return. This is the most direct channel from today's geopolitical news to your household finances. Part 2. The Black Swan Framework. Why this is exactly what Taleb warned about. Nassim Taleb published The Black Swan in 2007. His central thesis: events that are rare, extreme in impact, and retrospectively obvious are systematically underpriced by financial models. A black swan has three characteristics. It is an outlier, outside the range of regular expectations. It carries extreme impact. Despite its rarity, human nature makes us construct explanations for its occurrence after the fact, making it appear explainable and predictable in retrospect. The Iran peace deal collapse today is a textbook black swan in Talec's framework. Markets had partially priced in a peace resolution trajectory. the June 14th Hormuz fee abandonment, the temporary inflation decline, the reduced oil spike fears. When that resolution collapses, as it has today, markets reprice rapidly and painfully because the assumptions baked into every asset class simultaneously need to be revised. Oil higher, CPI higher, Fed rate cuts further delayed, semiconductor supply chain risk higher. Gold, our diagnostic tool from video 37, likely moves higher. Defense stocks surge, bond yields rise on inflation fears. The cascade from a single geopolitical event is rapid and interconnected in ways that simple models don't capture. This is what Taleb means when he writes that we live in extremistan, a world where extreme events dominate the distribution of outcomes rather than mediocristan, where outcomes cluster around predictable averages. In extremistan, the models calibrated to the Iran peace trajectory are wrong overnight. Part 3. The Alphabet and Tesla earnings context. What they tell us about AI reality. This week, specifically Tuesday and Wednesday, Alphabet and Tesla earnings will give some idea of where the semis go next. These are not just corporate earnings reports. They are the two most important data points for answering the central question your channel has been asking since video 33. Is the AI infrastructure boom generating real revenue at the application layer? Or is it a capital expenditure cycle without a matching revenue cycle? Alphabet is the definitive test case. Google's parent company is simultaneously one of the largest AI infrastructure spenders through Google Cloud and DeepMind, and one of the largest AI application companies through Google Search, YouTube, and Google Workspace. If Alphabet beats earnings expectations while also delivering strong guidance on AI revenue, the AI bull case gets a fundamental underpinning. If Alphabet disappoints, particularly on search revenue, which faces genuine competitive threat from AI assistants, the IBM and Netflix pattern from videos 41 and 43 gets confirmed as a trend, not an aberration. Tesla is the second test. Tesla's AI ambitions, specifically the Optimus humanoid robot program and the full self-driving autonomous vehicle technology, represent the most ambitious application layer AI bets of any non-software company. Several Magnificent Seven stocks lost steam after last year's outsized gains. Tesla has been among the most volatile of that group. If Tesla delivers on AI timeline, particularly on Optimus and FSD monetization, it validates the broader AI application thesis. If Tesla disappoints, as IBM and Netflix did, the AI rotation that's been pulling money out of semiconductor stocks has a fundamental justification rather than being purely momentum-driven. Part 4. The WarshGPT moment and what it means for Fed communication. WarshGPT Wall Street adapts to new era of Federal Reserve communications. This CNBC headline from Friday, July 18th is actually one of the most important stories this week, and it's getting zero attention. Kevin Warsh's elimination of forward guidance, which we covered in video 40, has forced Wall Street firms to build AI models specifically designed to interpret his cryptic, data-dependent communications. The nickname WarshGPT reflects how profoundly the Fed's communication style has changed. Under Powell, the Fed provided explicit dot plots, forward guidance, and press conferences that telegraphed future moves months in advance. Under Warsh, the Fed says, "Look at the data, we decide at each meeting." Wall Street has responded by building AI tools to interpret every word, tone, and pause in Warsh's public statements. This is a structural change in how markets function. It means that today's Iran news, which directly affects the inflation data that Warsh says will drive his decisions, has a more immediate and unpredictable connection to Fed policy than at any point in the last 15 years. The cascade works like this. Iran collapse, oil prices rise, CPI moves higher, Warsh data dependent approach means October hike probability rises immediately, bond yields rise, and growth stock valuations under pressure. Semiconductor stocks that were already down 10% for the week face additional pressure. In Taleb's framework, this is the interconnection of fragile systems that amplifies black swan events. Part 5. The prediction markets angle and the tax question nobody is answering. How are prediction markets taxed? The IRS hasn't provided guidance yet. This CNBC headline from July 18th is a genuine financial planning story hiding inside the market news cycle. In video 19, we covered prediction markets, Kalshi, Polymarket, and the explosion of retail participation in event-based financial betting. Now, with the Iran peace deal collapsing today, Those prediction markets are pricing the probability of various outcomes: renewed conflict escalation, oil price spikes, possible military intervention timescales in real time. The tax question matters specifically because millions of Americans are now using prediction markets as financial instruments without any IRS guidance on how their gains and losses should be reported. The IRS hasn't said whether prediction market winnings are ordinary income, capital gains, or gambling winnings, each of which has dramatically different tax treatment. If you've been using Kalshi or Polymarket to bet on geopolitical outcomes, including Iran-related events, and you've made money, you're currently in a legal gray zone on taxes. This is a story that will become more urgent as the Iran situation evolves and prediction market volumes spike. Part 6. What to actually do. The Taleb Informed Investor Framework. Here's the honest, practical section. Applying Taleb's Black Swan framework to today's specific situation. Taleb's core investment advice is counterintuitive and deeply practical. Don't try to predict black swans. Build a portfolio that can survive them and occasionally benefit from them. His specific framework, which he calls the barbell strategy, maps directly to what we covered in video 39 with the 60-40 portfolio debate. On one end of the barbell, extremely safe, low-return assets, short-duration treasury bonds, high-yield savings accounts, cash equivalents. These provide stability and optionality when black swans hit. On the other end of the barbell, a small position in assets that benefit from extreme volatility and uncertainty. Gold, which we covered in video 37, is the classic example. Defense stocks benefit from geopolitical escalation. Energy stocks benefit from oil price spikes. Short positions on highly valued, Iran-sensitive growth stocks provide exposure to the downside scenario. In the middle, nothing. The traditional 60-40 approach of holding moderate risk bonds and moderate growth stocks is exactly the zone Taleb warns against in a black swan environment. Moderate risk assets get hit on both sides when extreme events hit. They don't provide the safety of cash, and they don't benefit from volatility the way gold or energy does. Applying this to July 20th, 2026, cash in high-yield savings accounts, still earning 4% or more, is now more attractive than it was last week because the Iran collapse has increased uncertainty materially. Gold, our diagnostic tool from video 37, is likely to benefit from both the geopolitical risk and the re-acceleration of inflation that oil price spikes will cause. Energy stocks, which were the only sector positive on Friday according to Edward Jones data, have a direct fundamental tailwind from the Iran collapse. Technology stocks with high Iran-related supply chain exposure, specifically semiconductor companies with Taiwan-dependent manufacturing, face additional risk on top of last week's 10% sell-off. Alphabet and Tesla earnings this week become even more important as the first major fundamental test of whether AI revenue can offset the geopolitical headwinds. Final verdict on the Black Swan. Should you read it in the context of today's Iran news? Yes, immediately. Taleb's framework is the most useful mental model for understanding why markets are repricing rapidly today and why the models that said the Iran peace deal was on track were systematically underpricing tail risk. My rating, 10 out of 10. Difficult in places. Occasionally combative in tone, Taleb is famously prickly. But the central insight, that the most important events are always the ones that fall outside the range of regular expectations, is the most important idea in modern risk management. The honest bottom line for July 20th, 2026, Iran has called off the interim peace deal. 2 U.S. service members are dead. The geopolitical risk premium that markets had partially priced out is back. Oil prices are rising. The Fed's rate path just got more complicated again. Alphabet and Tesla earnings this week will tell us whether AI revenue is real enough to withstand this geopolitical headwind. Your portfolio framework should reflect higher uncertainty, not confident prediction. In a world of black swans, barbell positioning, gold exposure, energy exposure, and significant cash is the honest response to today's news. If this connected the dots across everything we've covered this year, subscribe to Earnings Per Page. Drop a comment with whether you think the Iran collapse changes the Fed's rate path, and whether you think Alphabet will beat or miss earnings this week. See you in the next one.